June kicking off with a flood of critical economic data ahead of next week's Fed decision as investors search for any clues into the path for interest rate cuts. Joining me here, Post 9, is Goldman Vice Chairman and former Dallas Fed President Robert Kaplan. Welcome. It's nice to see you in person.
Great to see you.
Okay, so let's just game this out. Next meeting, June, no cut.
Correct.
July, no cut?
I don't think so, unless something shocking happens, surprising happens.
September.
I think September is the first month where a cut is a possibility, but I think the Fed would need to see at least a few more months of improvement in inflation. If they see it, September is possible.
When you see predictions like Barron's has made over the weekend that says no cuts, Goldman is a little more aggressive on that side, obviously. What do you think? You sit back, you say, there's no way they're not cutting at all if the data continues to be what it is?
So I think it's hard to make accurate predictions right now, and I think if I'm at the Fed, I'm more in the risk management business, not the prediction business. And the concern they have is they want to see more sustained improvement, and the other concern they have, if they cut too early and you see a softening and in financial conditions and further appreciation, that could actually fuel stronger growth, consumer spending. So they're trying to thread that balance. And I don't think making a precise prediction is that important. I think the next move is likely to be down, not up, but the timing is uncertain.
Okay, so we just got a PCE that was, their favorite measure, allegedly.
Yeah.
You know it is. That was in line, okay? Yeah. So then we get one in June for May. So if that one comes in, fine. That's good. And then if we get in July for June, that comes in, that gives them the green light, you think, to go in September?
If I were in my former seat, I'd want to see, let's say we're right now headline PCE around 2 3/4. I'd like to see it continuing to moderately improve between now and September. I think they want to see not just sideways, they want to see moderate. I would want to see moderate improvement.
But what's the go level? 2.5? 2.5? Does that make sense? Is that like something we should put in our heads? Like if it's 2.5, that's the go?
I think it's a trajectory being improving. And the reason I'm being cautious here, and I think they'll be cautious, is you've got to remember fiscal spending is maybe more moderate versus last year, but we're running higher deficits than we did pre-COVID. You've got these special programs like Inflation Reduction Act, Infrastructure Act, that are open-ended spending programs. You've got a big increase in wealth that helps consumer spending, and which you just don't want to see a re-acceleration here. So there's no exact bogey, but you want to see continued improvement.
Well, see, this is the great debate, and I think it's been somewhat of a conundrum of sorts inside the Fed as to what degree is inflation caused by the traditional forces, excess demand, versus things that they can't control no matter what they do. And those are still the residual impacts from a pandemic, supply chain issues, and other variables that make this inflation unlike other inflation.
Well, you've got 2 or 3 structural issues that may not be COVID related that they have to contend with. We've gone from globalization to deglobalization, onshoring. Onshoring is expensive.
It's inflationary.
That's right. Tariffs on foreign goods is expensive. In addition, you've got a massive energy transition away from fossil fuels. That's expensive. And then you've got, beyond the money spent for COVID, you have American Rescue Act, Inflation Reduction Act, Infrastructure Act that added another $4 trillion plus of potential spending. So you've got restrictive monetary policy that's being blunted by those forces, and you're going to have to just turn over a few more cards to see how it plays out.
How can they, and how do you think they're thinking about the positive benefits and the deflationary forces of AI and technology itself, which is this incredible thing that we are still trying to figure out how to quantify it from an economic standpoint?
So there's 2 big disinflationary forces that they're monitoring carefully, and I'd be monitoring. One is we've got a jump in labor supply from immigration. Is that going to sustain or not? I don't think we know. I don't think they know. And then the second, to your point, could all this technology spending lead to a jump in productivity growth, which would be very helpful, means we could grow faster with less inflation?
We think yes, right?
Well, to some extent, and the jury's out. Also, understanding that a big chunk of the U.S. economy is services, and services in certain sectors isn't as sustainable to productivity improvements. So I think there's a great hope for that, but you want to see it manifest itself.
You worry at all that a Fed was late to hike is going to be too late to cut?
I think that I worried a couple of years ago that they were more than late. They were very late. They were 20 months late on bond purchases.
Late.
I think if they're late this time around, it'll be by a meeting or two. And so I think these issues will be tactical. You could argue waiting 20 months might have been a strategic mistake. I think the issues here are more tactical, so I'm not worried about a big mistake from the Fed.
So even if they wait a month too long to cut, you don't
They'll
think
fix it.
There'll be some sort of credit crack or crisis in which they're too late to react to? The dominoes would have already started to fall, and therefore they can't really fix it until they all fall.
My view is the Fed is pretty well positioned now. They weren't 2 years ago. I think they're pretty well positioned. My big worry, as you've heard me say before, is not so much with monetary policy getting that wrong. I think the Fed will get it right. Maybe not perfect, but they'll get it right. I'm more worried about the fiscal excess and how we manage that in the years ahead.